Hello from Accolend, your friendly no-points direct lender. In this short tutorial, we will explain the difference between loan sizing for 1 to 4 unit properties versus multifamily properties. We will also provide a more detailed tutorial on multifamily loan sizing in a separate video, so be sure to check our website for additional content. Sizing a multifamily loan is very different from sizing a 1 to 4 family loan. For 1 to 4 family, we always focus on loan to cost or loan to value and LTV/ARV. So, if you or your clients are focused on these types of properties, you are used to getting quotes based on these percentages. For multifamily, we do still focus on loan to value ratios, but also on the refinance loan amount the borrower will be able to obtain when the project is completed and the property is stabilized and fully leased. The refinance loan amount is highly dependent on the future DSCR or net rental income and the prevailing mortgage rates at that. Let's use a numerical example to demonstrate how loans are typically sized. The borrower buys a property for $1,450,000 and plans to spend $150,000 for renovations. The borrower expects to rent all units and to receive a gross rental income of $200,000. To calculate net income, we apply a 5% vacancy rate and a 35% expense ratio. Often, borrowers will say that their expense ratio is less than 35%, and in some cases, such as a ground-up construction project with tax incentives, it is. When we underwrite loans, we rely on the appraisal to provide expense ratio estimates. Historically, we see ratios of 28 to 40% depending on the type of project, such as ground-up versus renovation, or different property types, such as a tower versus garden-style apartment, location, etc. The underwriting team will review the appraisal numbers and the borrower's projections and assign the expense ratio. For the purposes of this tutorial though, we will use an expense ratio of 35%. The corresponding net income in this case is $123,500. We will size the exit loan using a 7.5% loan rate and 1.2 times DSCR. So, in our case, when the project is completed, we expect that the borrower will receive a bank loan of $1,227,000. Accordingly, our loan amount for this fix and flip property will be $1,227,000. And as you can see, this results in an overall loan-to-cost ratio of 77%. For multifamily loans, we can go up to 80% LTC, but in this scenario, we are not limited by LTC, we are limited by the exit loan amount, which limits our leverage to 77%. Let's take a step back and look at where we are today. 12 to 18 months ago, future DSCR was not a constraining factor. Back in 2022, we had mortgage rates at 3 to 3.5% and cap rates at 5.5 to 6.5%. Cap rates haven't moved much, but mortgage rates are now in the 7.5% range. So, if the cap rate is 6% and the mortgage rate is 7.5%, you are losing money by borrowing. Accordingly, leverage has steadily declined over the past 12 months to remain above 1.2x DSCR, despite the increase in rental income. To illustrate the impact of higher rates on loan amounts, we will use a range of interest rates between 3.5% and 7.5%. We will keep all other factors the same. Ready to see the impact? Drumroll please. Here we go. 12 to 18 months ago, your borrowers would have been able to get $1.9 million versus the $1.2 million today. The purpose of this tutorial was not to cover the pros and cons of investing in multifamily, so we will leave that for another time. But we did want to give you a brief overview of multifamily loan sizing. There are other factors involved, such as borrower experience, property type, location, etc., that we will cover in separate tutorials. We hope this information proved helpful for you, and as always, please give us a call at 201-643-6650, extension 1, or visit our website at accolend.com. We are happy to help.